Okay, so we are dealing with a merchandiser, and the financial statements of a merchandiser are going to be different from that of a company that works in the service field. Okay, so we're going to have, well, obviously we're going to prepare our financial statements in this order here. That's the proper order that we have to prepare them in. And so we're going to look at these figures we have here. Instead of giving us a trial balance, they're just listing the accounts and giving us the dollar amounts that go along with them. Okay, so let's take a look at the solution key and see how we should prepare this multi-step income statement. This is a little more complex than the single-step income statement that we had prepared in previous chapters. Okay, so of course we have our proper heading up here. We have our revenues from sales. Those are going to be reduced by an amount for any returns that were made to us and any discounts that we gave people for paying us promptly. Okay, so the sales reduced by these amount gives us our net sales right here. Okay, cost of merchandise sold. So we pay for this inventory, and once we sell the inventory, we can't keep it on our books as an asset. It's not a resource that belongs to us anymore because we've sold it to somebody. So, you know, the same way we purchase supplies and have them as an asset until we consume them. As we purchase inventory, and then later as we sell it, the portion of it that is sold we treat here as being cost of merchandise sold. Okay, so this is a type of expense, and it has a special name to indicate to us that it's related to the cost of inventory or merchandise that was sold. The difference between the net sales and the cost of merchandise sold is our gross profit. Next thing we have here, we have our selling expenses. So sales salaries, advertising. We have depreciation expense for the store equipment, right? So now you can see here below we have our depreciation expense for the office equipment listed under administrative expenses. So we're categorizing these guys based on their nature. These expenses are related to the sales process. Okay, these are related to the administrative, general or administrative. Office salaries, rent expense, depreciation expense on the office equipment, insurance expense, office supplies expense, miscellaneous admin expense. Okay, if we total those two guys up, these are our total expenses. So we've got our gross profit, which is our net sales minus our cost of goods, merchandise sold, gives us our gross profit. We reduce that by our total expense, and that gives us our income from operations. So all this up here, this is the core function of our business. It's what we do for a living. Okay? Below here, we're going to separate, we have income expense. This is going to be part of, it's going to fall in the other expense category because it's not related to the inventory that's sold. It's not a selling and it's not an administrative expense. So this is where it belongs. So as you remember, this $775,000 that is our net income is going to also find its way to our statement of retained earnings. Let's take a look at what that's going to look like. Okay, so we can tell from looking at the beginning figures that we have a starting balance for our retained earnings of $500,000, right? That's just given to us, $500,000. The next step is to add in our net income for the year, and we know from the previous financial statement that we prepared that was $775,000. Our dividends, we can tell that figure was given to us as well. So we distributed $150,000 of dividends. So that leaves us with $1,125,000 is our ending retained earnings. And as you're aware, this is going to next find its way to the balance sheet. Let's take a look and see what that's going to look like. Okay, so here we are. We have Carpet Land's balance sheet as of October 31st, 2012, as of that specific date. Okay, so let's take a look here. And so we have you remember from the previous chapter, we have our classified balance sheet. We start with our current assets. We have cash, accounts receivable, merchandise inventory, office supplies, prepaid insurance. These are our total current assets, okay? Next, we have our property, plant, and equipment. We have our accumulated depreciation that's related to the equipment, and we have the accumulated depreciation that's also related to the store equipment. Sorry, this is office equipment and this is store equipment. And remember, this number here is our book value for these assets. So the historic cost was $315,000. The total amount of depreciation that was accumulated was $187,000. The $315 reduced by the $187 gives us our book value of $128,000. The total of our current assets and our property, plant, and equipment, which is also known as PP&E, or fixed assets, the total of those two is $1,980,000. Now, this is the total of our assets, and we know based on the accounting equation that our liabilities and owner's equity are going to equal the same thing. So let's take a look here. We have our accounts payable, we have our salaries payable, we have our notes payable, $16,000, right? Remember, in this example here, we have a note payable. This is debt that's going to extend further than 1 year, right? So if we look at the figures, it tells us that $400,000 is the total of our notes payable. $16,000 of it is going to be due within the upcoming year. So we take that $400,000, we split it between $16,000 that's current and $384,000 that's non-current or a long-term liability. We look at the total of our current liabilities, they equal $221,000. The remainder of our liabilities are long-term. The total of our liabilities is $605,000. The next step, of course, is to calculate the total equity. The $250,000 in capital stock was given to us, and the retained earnings of $1,125,000, right? We calculated that right up here on the statement of retained earnings. Okay, so if we add those two together, our total equity is $1,375,000. If we add that to our total liabilities, we're looking at total liabilities and stockholders' equity of $1,980,000, which is equal to our total assets. At this point, we've properly prepared a multi-step income statement, a statement of retained earnings, and then finally our classified balance sheet. Let's take a look at another example or another problem here. This is example exercise 5.6. It says Zurich Company's perpetual inventory records indicate that $1,380,000 of merchandise should be on hand as of August 31st, 2012. The physical inventory indicates $1,315,900 of merchandise is actually on hand. Journalize the adjusting entry for the inventory shrinkage for Zurich Company for the year ended August 31st, 2012. Assume that the inventory shrinkage is a normal amount. So let's talk about this right here. Okay, so our accounting records, we're using a perpetual system. So every time we make purchases of inventory or every time we make a sale, we're updating the accounting records. And therefore, at any point in time, we should be able to look at our accounting records and have an accurate number for what the dollar amount of our inventory should be. However, we can tell that when we actually took a physical count, we only totaled, there's a difference between what our accounting records showed and how much we had, right? And that amount is called is shrinkage. It's how the inventory, it explains the difference between the two amounts. Shrinkage might be related to theft, damage, loss, things like that. But regardless, we need to adjust the accounting records to equal the amount that is actually in existence. If we take a look at the difference between the two, this is what our accounting records show, and this figure here is how much we actually physically counted. The difference between those two dollar amounts is $64,100. We need to reduce our inventory. We need to reduce our records from this $1,380,000 down to the proper amount. We do that by crediting this asset account by the difference. The debit goes to cost of merchandise sold. So we're going to treat this as though it's going to be expensed on the financial statements. Now this is not, if we go back to the problem, let's see what it says. It says here that the inventory shrinkage is a normal amount. Okay, now if it had not been a normal account, if it had been unusually large, it might have been disclosed separately on the income statement. In this case, it was not, so we can just leave it as part of cost of goods sold. That's it for this video. Please let me know if you have any other questions.